Ever found yourself wondering how the stock market works? Well, think of it as the beating heart of the global economy. It's a vast network connecting millions of people, each looking to make their fortune, or perhaps just a little extra on the side. In essence, the stock market is a place where companies sell pieces of themselves, known as shares. These shares represent a tiny slice of ownership in a company. When you buy a share, you're buying a piece of that company, hoping it will increase in value over time. But it's not just about individual gain. The stock market fuels economic growth, funding new innovations and creating jobs. It's a barometer of a country's economic health and a powerful engine driving the world economy. So next time you hear about the stock market, think beyond numbers and charts. Imagine the stock market as a gigantic global marketplace where buying and selling of shares takes place. The stock market isn't a confusing labyrinth. It operates on some simple principles. To start with, let's demystify a few terms. Shares or stocks represent ownership in a company. When you buy a share, you're essentially buying a piece of that company. Pretty cool, right? Now, a stock exchange is the marketplace where these shares are bought and sold like a supermarket for shares. Think of the New York Stock Exchange or the Bombay Stock Exchange. These are all places where buyers meet sellers to trade shares. Then we have indices. An index is a measure that reflects the overall performance of a collection of stocks. It's like a barometer for the stock market. Examples include the S&P 500 in the United States or the Nifty 50 in India. They give a snapshot of how the market or a particular sector is performing. Now let's talk about how share prices are determined. It all boils down to supply and demand. If more people want to buy a stock than sell it, the price goes up because the stock is in demand. On the other hand, if more people want to sell a stock than buy it, there's a surplus of supply, and the price goes down. Remember, share prices are also influenced by a company's performance and future prospects. If a company is doing well, or if people believe it will do well, demand for its stock goes up, and so does the price. On the contrary, if a company is underperforming, or if its future prospects look bleak, the demand for its shares will decrease, pushing the price down. But here's the thing, the stock market isn't just influenced by individual companies. Economic factors, political events, even global developments can affect supply and demand, and therefore, share prices. Simply put, the stock market is a reflection of the supply and demand of shares in the market. It's a dynamic ecosystem where every action has a reaction, where millions of decisions made by investors around the world shape the ebb and flow of share prices. You cannot just walk into the stock market and start trading, can you? No, indeed not. This is where stockbrokers come into the picture. Acting as intermediaries, they bridge the gap between you, the investor, and the stock market. They are the ones who execute your buy and sell orders and provide you with the necessary tools and research to make informed decisions. Just think of stockbrokers as your personal guides in the world of stock trading. They help you navigate the complex labyrinth of the stock market and make sense of the numerous stocks, indices, and financial instruments. Now, you might be wondering, how do you initiate your journey with them? This is where trading accounts come into play. Opening a trading account with a brokerage firm provides you with a platform to buy and sell stocks. It's like your gateway to the stock market. Stockbrokers are the bridge that connects you to the stock market. Their role is critical in your journey towards becoming a successful investor. So how does one buy or sell stocks in the stock market? You may be wondering, well, let's dive right into that. Firstly, you must know that all transactions in the stock market are executed through brokers. These are individuals or firms that are licensed to buy and sell stocks on behalf of their clients. You place your orders through them, and they execute these orders in the market. Now let's talk about the types of orders you can place. The two most common types are market orders and limit orders. A market order is an order to buy or sell a stock at the current market price. This type of order is executed immediately, as long as there are willing buyers and sellers. It's like walking into a store and buying a product at the price tag. On the other hand, a limit order is an order to buy or sell a stock at a specific price or better. For example, if you place a limit order to buy a stock at $20, the order will only be executed if the stock's price falls to $20 or lower. Similarly, a sell limit order at $25 will only be executed if the stock's price rises to $25 or more. It's like setting a budget for your shopping and sticking to it. The choice between a market order and a limit order depends on your priorities. If speed is your priority, then a market order is your best bet. But if you're more concerned about the price you're getting, then a limit order is the way to go. Finally, let's touch on the role of timing in stock trading. The stock market is dynamic, with prices fluctuating throughout the trading day. Therefore, timing your trades can significantly impact your returns. It's like catching a wave while surfing. If you catch it at the right time, you'll ride it to the shore. But if you miss it, you might just get wiped out. Buying and selling stocks is like a strategic game where timing is everything. So be strategic, be patient, and always keep an eye on the market. Like any marketplace, the stock market also comes with its risks and rewards. Now, let's dive into the nitty-gritty of what these risks and rewards actually are. The most prominent reward of investing in the stock market is the potential for significant financial gain. When you purchase a company's stock, you're buying a small piece of that company. If the company does well, the price of the stock goes up, and you can sell it for a profit. This is the fundamental principle of investing in stocks. However, the flip side of this potential for profit is the risk of loss. The stock market is not a one-way street to riches. If the company you've invested in performs poorly, the value of your stock may decrease, and you could end up losing money. This is the inherent risk that accompanies the potential for high returns in stock trading. This leads us to the concept of volatility, a term you'll often hear when discussing the stock market. Volatility refers to the rate at which the price of a security increases or decreases for a set of returns. It is measured by the standard deviation of the annual return. A stock with high volatility can potentially lead to large swings in price, which could mean substantial gains or losses. So how can you navigate these risks and rewards? The key is research and informed decision-making. Before investing in any company, it's crucial to thoroughly research the company's financials, management team, industry position, and other relevant factors. This will help you make an educated decision about whether or not the company is a good investment opportunity. Moreover, it's important to diversify your portfolio by investing in a variety of different companies and sectors. This can help mitigate the risk of loss if one of your investments performs poorly. In the stock market, knowledge is power. The more informed you are, the better your chances of success. So why bother understanding the stock market? Well, let me tell you about the power of investing. It's a tool, a vehicle that can drive you toward financial growth, and it's not just for the suits on Wall Street. It's for anyone with a little spare change and a lot of patience. Investing is like planting a seed. You put your money, your seed, into a company, the soil. Over time, with the right conditions, that seed can grow into a mighty tree. Just like a tree, your investment can provide shade or, in this case, financial security. It can bear fruit, dividends that you can harvest and enjoy. The more seeds you plant and the more time you give them, the larger your financial forest can grow. But remember, it's not just about planting the seed, it's also about nurturing it. You need to tend to your investments, keep an eye on their growth, and make adjustments as needed. This doesn't mean you should panic and pull out your seed at the first sign of a storm. No. The most successful investors are those who weather the storms and have patience. Long-term investing is the key here. It's not about making a quick buck, but about building sustainable wealth over time. It's about recognizing the power of compound interest, the snowball effect that can turn small, regular investments into a substantial sum. And the best part? You don't need to be a financial whiz to start investing. You just need to start. Start learning about the stock market, start understanding how it works, start making informed decisions. The stock market can be your key to financial growth. And remember, every great investor started with a single step. So, are you ready to take yours?